What is up, you guys? Pete DiCarlo here, and today we're going to be talking about Netflix. We're going to be going over Netflix Q4 2020 earnings. We're going to be going over what are analysts looking at. Why is the stock up 10% right now? Because if you briefly look, they didn't beat on top line and they did beat on the bottom line revenue, but just barely. So why is it up? And overall as well, is Netflix a buy right now? It's $570 a share. We're going to go over all that, and ultimately I'm going to give my verdict on if I would be buying this long term. But before we do that, make sure you hit the like button. Make sure you subscribe to this channel. It really does make a huge difference. It helps to get these videos out there, and it helps this channel to grow. So let's get started and let's look at the numbers. So Netflix shares rise 13% on strong subscriber growth. Considers share buyback. So couple of things within this headline. Number one is subscriber growth. That's the biggest and most important thing when you're looking at most of these subscription-based tech companies. So Zoom, that's a huge number for them. Netflix, that's what they look for, is subscriber growth. What you'll notice, like I said earlier, is that they actually missed on an EPS base point, and from a revenue standpoint, they actually just barely made it. But subscriber growth is what's extremely important, and we're going to talk about that. And the other is considering a share buyback. So I'll ask you guys this question. If a company's thinking about buying their shares back, do you think the company thinks the stock is overvalued or undervalued, right? Obviously undervalued. Why would a company ever buy back their shares at a price that they think is too high? Normally, when a company says they're going to be doing stock buybacks, it's because the company believes that the price of the stock is much lower than what the stock and what the company is actually worth. So that's always a bullish sign. And let's get into it. So let's see. Netflix reported fourth quarter 2020 earnings on Tuesday and beat the analyst expectations on net subscribers and revenue additions, but fell below EPS. So they did miss EPS. We'll get to that. The company said that it is close to being free cash flow positive and will consider returning cash to shareholders through buybacks. Netflix said that it will no longer need to raise money financing for its daily operations. So that's always good. All right, so here are the key numbers. This is what's important. Earnings per share, $1.19 versus $1.39. So they missed on earnings per share, but at the end of the day, it's really not that big of a deal. Revenue, they just barely made it, $6.64 billion versus $6.62 billion. So they just barely made it by about, not much at all. And global paid net subscribers, which is the most important thing. Like I said before, this is what everybody's looking for. 8.5 million. 8.5 million versus 6.47 million expected according to Street Account. That is huge. I talked a little bit with my team this morning about how this is so important because I don't see much growth for the company within the Americas. Everybody here probably has access to Netflix, or at least knows somebody who has access to Netflix, and you're probably using their account. But at the end of the day, it's really about the global growth of the company, not necessarily the growth within the United States. And they've done an amazing job at it. So 8.5 million, that's like a 33, I'm sorry, not 33, what was it, 6, about like 35% growth over what they had expected at that 6.4 million. Netflix expectation of soon becoming cash free positive would bring the life of the bull case for the stock. Netflix said it will no longer need to raise external financing for daily operations and would even explore returning cash to shareholders. Netflix hasn't made such a move since 2011, a pivotal year in the company's shift from DVDs to streaming. The company said it does intend to pay down more of its debt as well. It raised $15 billion in debt since 2011 and currently has $8.2 billion cash on hand. We're going to look at the financials in a little bit too. Netflix has been free cash flow positive for the last 3 quarters, though executives mostly credited that to an effect of postponed production during the Roni. So one thing you have to realize is while they make a ton of money, Netflix blows an insane amount of money creating all of these Netflix originals, which obviously that's why Netflix has grown into the mega giant that it is right now, because at this point it is a production house. It's not just a streaming service, and they spend a lot of money. So the fact that they're cash flow positive for the past 3 quarters is great, but at the end of the day, it's because they're not shooting as many TV shows and as many movies, which takes a lot of money to do. So let's see. In Q4, Netflix had to contend with several new competitors in the streaming service industry, such as Apple TV, Discovery, Disney, HBO Max, and AT&T's Warner Media package from CNBC parent NBC Universal. And Viacom Paramount still has theirs to come. Executives said in a letter to shareholders in 2020 was a testament to the company's approach of improving the platform for subscribers and satisfaction to stand up to their competition. Disney Plus had a massive first year, 87 million paid subscribers, and we recorded the biggest year of paid subscriber membership growth within our history. So one thing to think about, which we're going to start looking now at actual Netflix and some of their financials, one thing you really have to think about is the economic moat for Netflix is very, very narrow. So if you guys don't know what a moat is, essentially analysts use this as a way to gauge if a company, number one, can keep competitors at bay, right? So if you look at some company like Amazon, I think Amazon has a wide economic moat, even though there are a lot of companies like, Walmart and Target. I still think that Walmart and Target are nowhere near what Amazon is. Amazon can keep competitors at bay. Netflix has a very slim economic moat that, you have Disney Plus, Viacom, you have, like we were saying, CNBC, you have Apple TV, you have Hulu, like all these different things that can start to encroach on the market share of Netflix. And something you have to realize is the reason that people switch over to streaming is because, instead of having a cable bill of like $220, you can get an internet package for $60 and then have Netflix, which I think is like $15 now. You could have Disney Plus, which is $15 now if you get all three. You could have Apple TV, which I think is like $6. You could have HBO Max, which is like $15. And the thing is, at the time, Netflix was like one in its own. So really, for like $70 a month, you can get a ton of shows, a ton of movies, and just use internet. Now, I think a lot of people are going to start being a lot more selective of the different streaming services they use. And I think that what Netflix did was a great job of making themselves more of a production company, because a lot of the reasons that people watch Netflix is because of Netflix originals. If you look now, there's not a lot of shows that are not Netflix originals on Netflix anymore, because the parent companies or the companies that own the rights to those shows and movies either are licensing them through something else. Amazon Prime is another one, I forgot. Or what they're doing is actually creating their own shows or just putting them on their own networks. So at the end of the day, I think the economic moat is very slim for Netflix, and it's a huge reason why in the next 10 years, I'm not bullish on Netflix personally, and we'll kind of talk about that a little bit more. So obviously, if you guys don't know what Netflix is, you've been living under a rock, but essentially they're a streaming service that now is making mostly their own content. So this is Morningstar. They have an analyst rating of 1, which is probably one of the worst things that you could possibly get. It's been trading right now at about $570 per share. They have a fair value of $200 per share. So that's what they believe is a fair price for Netflix. Personally, I don't want to say I agree with 200. That is very, very, very cheap. I believe maybe about 300, 350, and we'll kind of talk about this in a little bit. Let's move to the financials, and let's take a look here. Let's zoom down. Also, I really like to use Morningstar. I'm going to be using this in a lot of these videos now, because while I used to use TD Ameritrade to show my financials, at the end of the day, it is a lot easier to just look on Morningstar, because it gives you a very quick run through of basically everything I look for, which is revenue, operating income, net income, assets, and liabilities. So let's take a look here. So for those of you who don't know, TTM means trailing 12 months. You can see here that 2017, they did 12 billion in sales, 16 billion in sales in 2018, 2019, 20 billion, and TTM means trailing 12 months. This, I believe, does not include today. So this would be the following 12 months, 23.8 billion. So slowing growth, right? If you look at 2018 to 2019, we have about a 25% growth from 2019 to now, not nearly as much. If we look at operating income from 2019, 2.6 billion, the past 12 trailing 4 billion, we'll call it straight up, about 4 billion. Net income, 1.87 billion in 2019 and 2.8 billion in the past 12 months. So, rising revenue, which is good, and then rising net income, which is good. You don't want to see like revenue going up, but net income going down. Then again, you also have to realize that this this number right here of the trailing 12 months, if you look the past couple of quarters, like stated before, they actually were not producing as much shows, as much content, which therefore means that they're going to end up keeping net a lot more of their money, which means you're going to get a much higher number here in the trailing 12. If we look at a balance sheet, you can see right now they have about $38.62 billion in total assets, $28.29 billion in total liabilities. So I like to see a 2-to-1 minimum, which means I'd really want to see $60 billion in assets. Total debt is $16 billion. Total equity is $10.3 billion. And if you look at cash flow, really not the best numbers. At the end of the day, I really don't like Netflix at these prices. I'm not saying the business model is flawed. I really just think that at the end of the day, this is kind of getting a little crazy. The fact that we're trading all the way up here at $560, I don't really think that it's one of those, stocks. And let's get over here. Actually, let me move this, make this smaller. I don't think it's one of those companies that like, oh, it's just moved up so much, it's so fast that it needs to correct, like something like, Tesla. As much as I love Tesla, I don't think if you're buying Tesla for the next year that you're buying at a good price personally. And I don't think it's one of those things where it's just like Netflix overall is going up too fast. It really, if you look at the past 180 days, Netflix has not moved that much. If you look at the past 3 years, Netflix is up about 150%. But if you look at it before the Roni, we really only moved about 20-30% in a year and a half, which is good for a company that big. And then you look now, we really haven't moved that much. We're back up to 560. I just think that for the longest time, Netflix has been overvalued, which is a problem. Looking at the bull side, right, they're doing really good job at making great content that is 100% their own. If you want to watch the Netflix content, then you have to watch it on the Netflix platform. I think a bull side is they are pioneers within the streaming industry, and they're a brand that people will stick to and flock to. And I think that another bullish thing is they can just kind of continue to raise their prices like every 6 months by $1.50 a month, and people will continue to pay it. I don't think that they'll walk away. The downside is, number one, it takes a lot of money to create the content. It really does. It takes a lot of money, and I think that these numbers are really fudged. The subscriber growth can't be fudged, but the balance sheet and the being free cash flow positive, I think it's like fudge number because they're not blowing as much money just making all these shows. We'll see what really happens in 2021 with more filming going on, but I do think that there's much more downside. The fact that basically everyone and their mother has a streaming service right now, and you have to realize in the world of streaming, this is all new, right? Netflix has been doing this for a while, but Netflix didn't have competition for a long time. Look at the competition now. You have the biggest hitters in the tech world going up against Netflix. You've got Disney, right, which is like a media company giant, and now, in my opinion, a tech company. You have Disney, which is another, not Disney, I already said that, Apple, which is a tech massive giant. You have Amazon going up against them. You have all of these different companies going up against Netflix. And I just think that when you look at the next 10 years, I would not be, maybe the next 10 years I'd be buying at these prices if you really feel that bullish. But for me, I will not be buying Netflix anywhere near the 500s. I would need Netflix back down. What was it even during the Rona? Even down at 285, that's not bad, but I would really need it at like 250 to 300 minimum for me to be taking a long-term position in Netflix. I hope that this video helps you guys. If you completely disagree with me, let me know. If you completely agree with me, let me know. I love to hear from you guys. It really means a lot to me. It helps me allow to make videos that are catered towards you guys, because that's what this channel is for. Make sure you hit the like button. Make sure you subscribe to this channel, and I'll see you guys next time. Peace.